Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. You see, as a value investor, there is no better time to buy stocks than when the markets are falling. Of course, there is no rule that says that you cannot buy stocks when the markets are rising. However, a falling market or a market that has fallen quite a bit from its top is a value investor's best friend. Why? Simply because a lot of the stocks that he could not buy due to their high valuations turn attractive after a significant market fall. Now, we all know that the Indian markets have fallen a good deal from their all-time highs. At the time of recording this video, the Sensex is down almost 15% from its highs, whereas the mid-cap and the small-cap indices are at the cusp of entering a bear market. This means that a lot of mid and small caps have crashed big time and may now be available at attractive valuations. Which brings me to the most important question. If the entire market has taken a beating and if one wants to take advantage of this opportunity, what are the kind of stocks that an investor should buy? Should one look at only blue chips and buy the ones that have fallen the most? Or should one capitalize on the much bigger fall in mid and small caps and invest in stocks from this space? Last but not the least, should one invest the full amount that one wants to invest or take only a partial exposure right now? Well, you may think that these are tricky questions to answer. A lot of analysis will need to be done before we can come to any definite conclusion about which stocks to buy and how much. And above all, you may think that all of this is beyond the reach of an average investor. Nothing could be further from the truth in my view. These questions do look tricky, and it does appear that we may have to burn the midnight oil in trying to find convincing answer to each one of these. But to be honest though, if you know the core concepts of investing and understand where to draw the line between things that you should consider and things that you should leave out, the entire situation boils down to just a few simple principles. Let me help you understand these principles using an interesting case study. In this case study, I have chosen 3 sets of companies with 3 companies in each set. So there are a total of 9 companies divided into 3 groups or sets, if you will. The first set will have 3 poor quality stocks from 3 different sectors. The second set will have 3 average or decent quality stocks from the same 3 sectors as the first set. And the third set will have 3 very good quality stocks, again from the same 3 sectors as the first and the second set. In fact, let us go with the classification that Warren Buffett uses. Buffett once mentioned that he likes to segregate companies into great, good, and gruesome. He calls the best quality businesses as great, an average quality business as good, and a poor quality business as gruesome. So we will also have 3 sets of 3 companies each and call each set as the great, the good, and the gruesome. Now here's something very interesting. I looked at the stock price performance of all the 3 groups between March 2020 and May 2022, and this is what the returns looked like. The gruesome group, the group with the so-called bad quality companies with poor fundamentals, did the best. They turned every rupees 100 invested in the 3 companies equally into almost rupees 1700. That's a huge 17-bagger in just over 2 years. That's an incredible return, and that too from the group with arguably the worst quality companies. The group with the so-called good companies stood second, turning every rupees 100 into almost rupees 500, resulting into a near 5-bagger. The most surprising part was the performance of the great set, the group with the best quality companies. This group was almost at par with the benchmark index, giving 2x returns and underperforming both the gruesome and the good group by a big margin. So what is the single most important takeaway from this chart? Is it that when times are good, one should invest in gruesome stocks, companies with poor fundamentals and broken business models? The time was indeed good between March 2020 and May 2022, as the benchmark index is almost doubled and we've had a strong bull run. So does investing in bad companies make the most sense during a bull market and buying great businesses the least sense? Well, this takeaway or conclusion may or may not be correct, but before I answer this question, let's take a look at the performance of the same set of companies in the current weak market. Let us see how much each of these groups has corrected from its 52-week highs in recent times. Well, here's the chart to find that out. Now, this is exactly the reverse of the first one. The gruesome group has suffered the biggest decline from its 52-week highs. If you had invested equal sums in each of the three stocks from this group at their 52-week highs, you would be currently sitting on a huge 44% decline. In the good group, on the other hand, you would have lost slightly less, ending up with a close to 30% decline. Now, if you knew a correction was coming, then shifting all your money into the great bucket would have made a lot of sense, as this group has lost the least from its 52-week highs. So the key takeaway from this second chart would be that when times are bad, great businesses provide you the maximum protection against a big loss. So here are the two takeaways again. When times are good, you should invest in gruesome businesses even though their fundamentals are very poor. When times turn bad, you should get into great businesses as they provide the maximum protection against a loss. Well, I have an issue with both these takeaways and I'll tell you why. Take a look at the three stocks that are part of the gruesome group. These are companies like Eastern Silk, Shalimar Paints, and 3i Infotech, a textile stock, a paint stock, and an IT stock. These three stocks have done really well on the stock market in the last couple of years, as we just saw. In fact, 3i Infotech has turned out to be a huge 39 bagger, multiplying an investor's money by a whopping 39 times. The entire group has multiplied investors' money by 16 times during the same period. However, have a look at the fundamentals of each of these stocks. When our hypothetical investment was made in each of these stocks, all the three companies had very poor fundamentals. They were frequently loss-making, had leveraged balance sheets, completely eroded net worth, and very poor ROEs. I am sure a rational value investor wouldn't have touched any of these stocks even with a 10-foot pole. And this is exactly what he should do every single time. Even if they have ended up giving very good returns, I think these gruesome companies should be stayed away from. A company should have at least decent fundamentals, if not great, and one should be able to value them. However, there is no way one can value any of these stocks with any degree of confidence. Therefore, these stocks can be deemed speculative at best, where one can speculate with a small amount. But one should never put his long-term money into any of these counters. The fact that these stocks ended up giving great returns should have no bearing on your decision. Your decision should be based on fundamentals and whether valuation is possible. And as far as fundamentals and the ability to value these companies is concerned, they are both on extremely shaky grounds, which is why it is better to give these companies a miss. Investors should not think that these companies have fallen 40%, 50% from top and therefore they make for good investments. However, as I said earlier, investing in these stocks at any price is a high risk proposition and one cannot make money consistently by investing in these types of stocks. This brings me to the second group, which is the good group. Here are the stocks in this group. Again, a textile stock, a paint stock, and an IT stock like the first group. But these are much better companies by taking just one look at the financials. They are companies with no history of losses, strong balance sheets, and very decent ROEs. Each of these companies can definitely be considered for investment. However, if you want to earn very good returns from them, you must buy them at very attractive valuations. Take a look at the valuations when they were hypothetically bought back in March 2020. Both Ambika Cotton and Asahi Songwon were trading at single-digit PEs, while eClerx Services was also not expensive at a PE of 11 times. I think this combination of decent fundamentals and extremely attractive valuations led to this group emerging as a 5-bagger between March 2020 and May 2022. Now let us move on to the third group. Once again, the same sector combination of textile, paints and IT. But these are now the bluest of blue chips. These are market darlings and widely recognized as very high quality stocks. One look at the fundamentals and you can see why. There is quality of earnings, there is growth, there is very strong balance sheet and very high return on equity. These stocks are an investor's dream come true. And yet they underperform not only gruesome and good stocks but also outperform the benchmark index only by a slender margin. How on earth did this happen? Why did a group of the best quality stocks underperform their lower quality peers between March 2020 and May 2022? Well, the answer perhaps lies in this next slide. These stocks were not all that attractively valued back in March 2020 and therefore they underperformed gruesome and good stocks. Only Page Industries was trading at a decent discount to its 5-year average PE of almost 70 times, whereas Asian Paints and TCS were trading at or close to their 5-year average PEs. I think this is the reason Page Industries outperformed both Asian Paints and TCS, but as a group, they underperformed the other two groups. Therefore, when it comes to quality stocks, even they can underperform over a 2 to 3 year period and maybe even more if you buy them at expensive valuations. Quality stocks have a twofold problem. First, most people know that they are high quality and therefore they are seldom available cheap. Therefore, if your goal is to outperform the benchmark index over the long term, high quality stocks may not be the way to go unless they are available at a big discount to the PE multiple they have traded in the past. Another risk is that you pay a high multiple thinking that it's a quality stock, but it does not turn out to be so. In this case, you will suffer a double whammy in a way that its profits along with its PE multiple will both go down. Therefore, you will end up incurring a huge loss. So in conclusion, if your goal is to outperform the benchmark index, then perhaps buying good stocks at a single digit PE or low double digit PE and holding them for 2 to 3 years is the way to go in my view. Here are the revised takeaways. You should stay away from gruesome stocks no matter how bright the future prospects. Great stocks are seldom available at a big discount to their long-term PEs and hence they may not be your best bet for market-beating returns. Besides, they may not be great after all. Good stocks with attractive single-digit or low double-digit PEs may present you with the best chance of outperforming the market over the long term. So if you're looking to invest in stocks in the current market fall, first, stay away from gruesome stocks. And now you can either look for great stocks trading at a discount of at least 20 to 25% to the long-term average PEs, or you can look at good stocks available at single-digit or low double-digit PEs. I know there are times when such stocks are available in huge numbers and then there are times when they are not. But it won't be difficult to zero in on 15 to 20 such stocks at any given point in time. So, happy hunting. And that's all from me today. See you again in the next session. Goodbye and take care.